the melt up is your most likely scenario.
Right.
So why not above 3K in that case?
Right. So the melt up scenario for us is 30 to 50. And the main reason for that is with the Fed easing as it is doing now, and our base view is that it's a soft patch. If you go back and look at history, in those circumstances, equities have gone up sort of 10 to 15%. Now, the problem is that's our 65% probability for that. But there's still a 20% probability that you could have a true recession, right? So that would lead to a 20% drop. So sort of on a probability-weighted basis, we end up at 3,000.
I see. But for the time being, the base case is that soft patch,
yes.
One cut does the trick, and we move on?
No, I think you need to have at least multiple cuts.
Okay.
Yeah.
Go ahead. For how many basis points total do you think?
So we think it's something between 50 and 75 this year.
All right. Jeff, is that in line with your thinking, at least at this moment?
Well, look, I think we just have to listen to what the Fed's talking about doing. It's hard to get inside the head of the Fed. We're not fighting an environment of tight financial conditions. I think the market has seen too many superhero movies lately and thinks the Fed is the guardians of the economy and they have so many superpowers they can turn around any type of slowdown. But the Fed only has one superpower, and that is to loosen financial conditions. But we're not battling that right now. Financial conditions aren't tight. The global slowdown in the PMI, in auto sales, in profits really isn't tied to that. So I think the market has misplaced its trust in rate cuts, and whether it's 25 or 50 at the end of this month or 75 by the end of the year, I don't think that's really addressing the core of the issue causing the global economic slowdown.
So you're still sort of defending the cautious stance, Jeff. I mean, you and Lizanne have been cautious for a few months now and missed the run-up to records.
Yeah, well, we haven't taken back equity exposure yet. What we're telling investors is be broadly diversified. We're waiting for a better opportunity, I think, to pull back on stocks. But keep this in mind. You know, whenever we see an inversion of the yield curve, it's meant a reversal, meaning that those areas of the market that had performed the best over the prior years were the ones that suffered the most in that resetting of expectations. I think investors who have allowed their portfolios to be overweight tech, maybe overweight the U.S., are vulnerable to that next pullback, which could look like the fourth quarter when we saw such a sharp pullback both here and abroad. So I think investors being more broadly diversified is more important right now than deciding whether they're in or out of the market.
I mean, speaking of that tech trade right now, Maneesh, it's really going strong. It's up more than 1%. Where are investors in terms of positioning around tech into these key FANG earnings?
So I think, broadly speaking, what we have seen is that there has been, as you saw the chart earlier, people are sort of favoring growth right now. And again, if you look back last 60 years, there are 5 times when the Fed has ended up easing into a soft patch. And during those times, actually, growth stocks have outperformed. Now, valuations are obviously a concern, but what we see is that during these soft patch easings, valuations for S&P go by 2 turns. So valuation could keep expanding. So all the rally that we see during these soft patches is actually a valuation expansion. So I completely agree that tech valuations are a concern, but I think you could still get some upside from here.
Do you see a big migration in sentiment away from tech to any other sector in the back half or the first half of next year?
There could be some migration. I think the key thing is, of course, what's happening outside the U.S. And that's really impacting stocks with high international sales exposure, so industrials, materials, and so forth. If you start to see sort of accelerations in the China growth, that we there's a bit of a rebound happening. If that were to continue, then those sectors would start playing up. And then, because right now, tech is more of a secular story rather than a cyclical story.